Welcome back to my mini-series, WWMD. And for all of you who don't know what that is, it's what would Mark do if he was on a desert island, no phone, no calculator, and only a soccer ball and a Sharpie. How would I buy real estate on that desert island? What I'm going to talk to you about today is how to buy and analyze and determine whether a multifamily deal is something that you want to own. And we're going to get right into it right now. We're going to start with step number one on analyzing the numbers. So here, all by the numbers. Okay? So guys, when you find a deal, and we're going to go back and forth and move around, because when you decide on what you want to do in multifamily, okay, there's no limitation or there's no geographic limitation to where you can be. And let's make the simple assumption that we're buying 100 units or more, all right? Therefore, we can have our own property management system in place and our own property management staff in place. But let's first determine that we're going to a specific market. And let's pick a market like Houston, Texas, okay? Which, by the way, is going to be exploding because of the new president's drilling for oil. The state of Texas is going to be on fire, not with wildfires, but on fire from an economic standpoint. Once you find a piece of property, you are going to need to understand the numbers, the data. Real estate is all data driven and it's all process created. So the first thing we're going to do is we want to know what that property is doing today, currently. So we're going to go and we're going to ask the broker, the bank, the special servicer, the receiver, the attorney, whoever is selling it to us, okay, who's ever pitched us on the deal, you're going to ask them for the numbers. And how do we figure out what those numbers are? We ask for what's called a T3 and a T12 and a rent roll and our operating expenses and their full annual budget in place. Okay? What do I mean by a T3? Super simple, guys. T3 stands for the last 90 days. So it's a trailing 90-day financial snapshot of that property. So you know where that property is. It's going to tell you what the income was. It's going to tell you, you're going to tie it down to the rent roll. It's going to tell you what is the difference between the physical occupancy and the economic occupancy, because you'll get a rent roll and it may show a 90% occupancy, okay? But in actuality, they may only have a physical of 90, but an economic of 80, which means 10 is empty and another 10% are not paying, non-payers. They're physically in the unit, they're not paying. You want to base all your numbers on the economic occupancy, okay? This is going to give us a real good barometer what kind of asset we have. This is also, and this is the last year. That's what a T12 is. This is data that you're going to build out and model up what you're going to do with this deal. Okay? Everything else goes into your model and you can compare it against how you operate and how you run a deal. So I'm gonna cut it right here and I'm gonna go on to my next topic. See you right back in a minute. Guys, what is the value of a property based on? It's based on NOI, which equals net operating income-ola, okay? And that net operating income we are going to use to figure out what our cap is, and we're going to divide it against our price, and that is going to equal our cap rate, okay? A cap rate is all based on what assets have traded in that market, which means capitalization rate, and that's going to give us what our return is based on our NOI. So, simple example, okay? Here's the example. If we have $100,000 in NOI and we apply a 5% cap rate, that property is selling for $2 million, okay? Now, most guys in the multifamily space are willing to buy things for between a 3.5 to a 7 cap. Unless you're Grant Cardone and you're using investors' money and you're not giving them a fair return. He buys things at 2%, okay? Which, by the way, I think is not my style, and I don't believe that that's the right way to do it. And for all of you who understand real estate, you can actually look at his deals, but you can't figure out why he does them the way he does them, because they're embedded in the actual deal, and you'll never figure it out unless you're super damn sophisticated, like me. Okay, that was a little arrogant, I apologize. Okay, all right, so once we determine what our NOI is, okay, that is the benchmark for whether we're going to actually write an offer on the deal. And if you have determined that this is a good deal to do, we're gonna write an offer. So I'll see you back in 1 second. Numero tres, number 3, okay? Once you've determined the NOI, now we're gonna determine the market value of that asset in the market, okay? So we know what our income is, we know what the cap rate in the market is, and we know what we want to achieve as a desired cap rate for our money. So what do? You go back to your broker, or you go back to some of the different websites like CoStar, and you look at what these deals have traded for. What does that mean? Sold for, okay? We trade real estate deals like we trade baseball cards, okay? It's called a trade, all right? And I'll give you a funny thing. A lot of New Yorkers, they call a project a job. So they'll ask you, what jobs are you working on? It doesn't mean it's a construction job, it means it's a deal. And they started with this trading assets. I actually kind of like it. I use it sometimes, okay? So what you're gonna do is you're gonna determine the NOI. Then in that marketplace where you're buying the assets, you're gonna determine what the cap rate is. And how are you gonna do that? Data. We got all these numbers by data. So what do? You go to one of the sites and you look at what these deals have traded for. And you get 10 deals that meet similar asset profile, similar rents per square foot, and look at them. First, you're gonna do a comp on the sale price. Then, just for your own edification, you're gonna do a comp on the allowable rents, what they're renting for. And then we're gonna go a little further into this segment of how to force the appreciation. You're gonna know that the ability to raise the rents, whether it's a nickel, a dime, a quarter, okay, a dollar, all right? In multifamily, we go by a percentage, or we use based on a dollar value. So we renovate, we raise the rent, we move the rents by 10 cents, 11 cents, 12 cents, 17 cents. So if I buy a property and there are 3 other assets, and they're getting 125 cents or $1.25 a foot, and my asset is at 90, and I know I can improve it by putting 10 cents of improvement dollars on a square footage basis into the asset and end up with an extra quarter, I know that's a big swing and it's gonna create tremendous value. So I'll see you back here in about 2 secs. All right, guys, now we've located our market. We found a deal, gotta be discounted, okay? Because I cannot pay retail for anything. Philosophically, I have to buy my deals at a bargain basement price. And that is why I buy deals that are off-market bank deals. Or I'm buying from a receiver or a special servicer, or I'm buying the LP or the GP or the mezz or the pref or the first mortgage. That's my path to ownership. And guys, if you'd like to learn that path to ownership, we have a program called Multifamily Protege Partnership. Click the link below and we'll tell you about it. But let's get back to the lesson, okay guys? So here is what you need to understand. Now you've gathered all this information. You've put it into your model, okay, which tells you if you put in this much, pay this much, you're gonna get a return on your investment. You're gonna get a 1x, you're gonna get a 2x, you're gonna get a 2.5 multiple on the money that you put in the deal. I don't get hot and bothered unless I'm getting a 2.5x. I don't get hot and bothered unless I come out of the blocks with an 8% paid out cash return on my money. So if we were to take an investor in a deal, they're gonna get paid 8% every freaking month alongside my money. Because when I do a deal, it's my money in it. And if you're lucky enough to invest alongside of us, your money goes in the deal too. And by the way, we don't charge up our deals, we don't charge fees, we don't charge anything that any other syndicators do because they're all a bunch of scum fucking bags. So, loan terms. There's 2 types of loans, okay? There's a bridge loan, that's a bridge, okay? With people, cars driving on it, all right? It's a bridge loan. And then there is Fannie and Freddie. All right? And then there's bank debt. Right here, they're going to give you the most aggressive acquisition terms, but they will give you more leverage, more loan to value or loan to cost, okay? So loan to cost is everything that you're doing on the deal, plus your rehab, plus your points. They're going to lend you a percentage on that. Loan to value is based on it. They both have to correlate, okay? They can't be out of whack. They have to correlate, and every underwriter at any commercial lender is going to make sure they fit their square box in a square hole, okay? And that there is enough cash flow, and if there isn't, there'll be a reserve, an interest reserve, and you'll have to pay that up front. So you're going to have to bring some equity to the table on a deal, unless you're somebody that's had a long history like myself. And on most of these deals that we're buying, we're getting financing from the lender. It's interest only, it's sub 6% money, and it's 100% financing. All we're doing is providing a cash reserve and a rehab budget, and we're paying for that out of our pocket. So once you have picked the direction that you want to go from any of these lenders, you're going to ask them for a term sheet. That's a term sheet. And that is going to outline what they're willing to lend you. It doesn't mean you're only going to get one term sheet. And what you need to do is you need to have a very good commercial mortgage broker or relationships with very good commercial lenders. And I will tell you, they will either make you or break you. Once you do a few deals with them, they are going to want to jump on your bandwagon, and they're going to be calling you and saying, what's the next deal? So let's go to the last part of this segment. What would Mark do on it? Buying a multifamily, okay? And I hope you guys actually can do this, Okay, this is what I'm trying to do, is make people change their trajectory in their life. Be right back. Guys, we are back to fuck with you about multifamily deals. So now you've gone through finding your market, finding a property, writing an offer, putting it under contract, doing all these amazing things, and forcing the appreciation to determine how you are gonna make this property better. And what are you gonna then do? You're gonna do the analysis based on bing, data. And data is our numbers, and it's gonna give us a few things. Cash flow, which will be a cash on cash return. So if I put up $1, all right, $1, and I have $10 into the deal, my return is 10%. That's what my cash on cash return is, okay? The others are a little more advanced, but I'm gonna go through that. Your return on investment, okay, is what you're gonna make when you buy a deal and it appreciates and the value goes up, what you end up with. And then your internal rate of return, your IRR, is cash flow, upside, and tax write-off. Okay, can you read that, guys? Forgot the dot, all right? This is the most important, in my opinion, in real estate, okay? Because number one, I already told you earlier, we're not buying a deal unless it pays 8%. So if we don't have an 8% return out of the block, not buying it, okay? If we don't know where we can push this deal for our return on investment, not happening. And guess what? You make your money when you buy your deal. You just realize the gain when you trade it. That internal rate of return gives you your tax savings. And based on the new administration, they're gonna do 100% bonus depreciation. We can use a cost segmentation study and we can push our dollars to reduce every dollar that we invest as if we put in 30 cents, but we're getting a dollar benefit because we're gonna get that tax loss, okay? And if you wanna know more about this, we'll do a segment on it. Just send us a message, okay? On bonus depreciation. You're also gonna get the appreciation on a deal, and you're also gonna get the cash flow. You put those three together, and that is your internal rate of return. So if I put in $1 and my property went up $50, I got my dollar back plus $50. That's a pretty insane internal rate of return. I sheltered some of the income. I had cash flow. And what I've done is I have grown my wealth. Why multifamily? And why do we focus on multifamily? Because multifamily is scalable and sustainable. It's data-driven. And it is also a necessity. You see this? I have a roof over my head. You need a roof over your head. Everybody needs a roof over their head. And I want to just leave you with three little things. At Shapiro Capital, we don't own apartment buildings, we own apartment communities. At Shapiro Capital, we don't have tenants, we have residents. And at Shapiro Capital, we don't have problems, we have situations. And these are all resolvable. You have to learn what you're doing, and that's how you learn it, by doing it or having somebody who's done it. And that's what we do, we teach that here. So guys, let's go, baby. Love to teach the multifamily space. I'm here for you. Guys, if this is something that appeals to you and you want to learn some more, what I'd like you to do is either check us out in our school community, okay? Or click the link below and book a call with one of my trusted advisors and ask them, tell them, Mark said, I'm gonna be on the call. And they may put me right on the call with you guys because I actually do that. Let's go, baby.